Yes,
Yes,
ma'am.
ma'am.
Chalo.
So hello everyone. I welcome you all in today's virtual program of One Big Beautiful Bill Act tax implications to Indian MNCs and US NRIs by a learned speaker CA Shrenik Kotak. So before starting the program, I would request to play our ICI motto.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Friends, as rightly said by Michael Jordan, talent wins games, but teamwork wins championship. So under the dynamic and visionary chairmanship of CA Ketan Sayya sir, it has been 6 months and 5 days new team has taken over and around 60,000 hours of CP training has been imparted under various programs and initiatives such as Bhagyoday. We have help desk for direct tax, indirect tax, virtual program, industry specific for GST. Apart from that, we have 10 study groups and so on and so forth. With this, may I request our visionary chairman, sir, to give us opening remarks.
Thank you, Jinal Madam. Thank you so much, Shrenik Bhai, for sparing your valuable time and making us learn about this something new. WRC has been always at forefront, and we try and pick up newer topic for the benefit of all of our member. Madam, we are always trying and bringing the new concepts, new act which are being introduced. We are working already on some such other act also, for example, DPDP, and soon you will see a seminar on DPDP as well as a publication on DPDP. We are working on both. Not only this, WRC has been trying and doing its best by organizing seminars on all different areas. First time ever, we have organized International Tax and FEMA RRC at COE Jaipur, which is happening on 10th, 11th and 12th of October, and requesting all the members to take advantage of the same. We are running a series called Niryat series. Tomorrow we have a session, physical session, the second session in Niryat series, which is on opportunities in UK. Requesting members to take advantage of that when India is, working as an accounting capital of the globe. These type of sessions are very useful where practicing CAs, the chartered accountant in India, explore the opportunities overseas. I think we already had successfully few seminars on opportunities in Dubai, opportunities in Middle East, opportunities in the Singapore is on the way, opportunities of various other countries. The programs are being organized. So with this, once again, welcoming you to all of you to this session and thanking once again the Shrenik for sparing his valuable time, and also compliment to Zinal Madam for organizing today's session and inviting the Shrenik to today's session. Thank you so much. Back to you, Zinal Madam.
Thank you so much, sir, for your words of wisdom. Friends, in coming month, we also have 2 days conference on internal audit. That is physical one at WIRC. I request everyone to take your active participation. With this, may I request our today's coordinator, CA Akansha Singh, to introduce our today's learned speaker. Over to you, Akansha.
Yeah, thank you, Jinan ma'am. I welcome everybody on behalf of WIRC and would like to, it's a pleasure for me to welcome CA Shrenik Kotak, He's a director with Grant Thornton Bharat. He's based in Bangalore. He's also leading the South practice of US tax for GT Bharat. He's an Indian chartered accountant along with US CPA with over 13 years of experience, including 10 years in US tax. He has extensive experience in corporate tax and partnership tax. He has rich experience in dealing in startup ecosystem and helps company end to end to meet their US tax compliance requirement, and also provides his invaluable experience in advising them. He's also working closely with US entities of many listed companies in India in their tax advisory, due diligence, compliance, etc. So over to you, Shrenik ji. It's a pleasure to have you, and please guide us through the program.
Sure. Thanks, Akansha, for the introduction. First of all, thank you, Chairman sir. Thank you, Jinal ma'am. Thank you all the dignitaries for giving me this opportunity to present my views on the recent tax bill. It has been, to be honest, I was very surprised and how WRIC and everyone has been expanding overall the topics of the coverage which we are doing it for the members and the knowledge session which we are conducting it. So it's a great initiative, and thank you so much for giving me this opportunity to present today my views on this OBBBA bill, which has been making buzz since the July month, I would say, when it became act on July 4th, which is the US Independence Day. So with that, I will just start my presentation. So just give me a minute, I'll share my screen. Yes. So before we start, I would like to just give you a bit of a context on how this bill came into the picture, what we are going to discuss today in this session, and what will be the relevant topics which may be relevant for your clients where you are dealing with the Indian parent with the US subsidiary, or you are dealing with the US NRI who is living in India. So when in the President Trump was elected in the first term, which is in 2017, 16-17, he introduced Tax Cuts and Jobs Act, which became a legislative somewhere around in November 2017, and it was a historical landmark act which came into which kind of almost changed everything on how the US tax was being perceived, how the US tax was working in the US, for that matter, for the Indian MNCs, for the local companies. So from each of the individual till the companies, everyone was impacted by that. Post that, I mean, he was expecting it that in the second term, he will see the benefit of this act. However, the COVID hit, he could not be re-elected, and then ultimately he came again as a president in 2025. So this bill or this reform was kind of expected. It was not expected that it would be coming in too early, but to be honest, as a US tax professional, it was a very exciting month, I would say, as a June month, wherein from the first bill starting in the month of June, from going into the Senate Finance Committee, then to the Senate, and making it finally to the act on July 4th. So it has been I would say, long ride for a president also to make this bill as an act in the span of 45 days or so, and signing it on the Independence Day. So in this session, we will be mainly covering some of the provisions which were kind of getting expired down the line, or kind of the tax rates were increasing. So how this has been reinstated, what changes has been done, what are a few permanent extensions which I would say has been made for the temporary provision which were introduced in the Tax Cuts and Jobs Act. So when I refer to TCJA, just consider it a Tax Cuts and Jobs Act, and OBBBA means One Big Beautiful Bill, which has been recently passed. Certain changes which were there, which were impacting our US NRIs also, or the US HNIs, giving it certain reliefs to the US-based NRIs, kind of giving the marginal rate relief, giving certain exemptions, kind of that. US corporate, I mean, to be honest, many Indian MNCs, especially the technology companies, were waiting on certain relaxation in terms of R&D deductions, certain international regime tax which they have, and also there has been a popular news, I would say, wherein that if you make a payment from the US, there will be a 5% tax, which was making a buzz, and there were so many articles which all the US tax preparers was talking about, and ultimately it was there were major relief which was given in this act. So we are kind of dividing this session into two parts. First, we will be talking about the changes which are related to the US NRIs, and then we will be moving it to the corporate side of it. So please feel free to drop any question you may have while in the session, and I will answer it for you as much as possible post my session. So yes. So as I mentioned, TCGA was signed in December 2017, wherein this new sections, I would say, which was introduced, GILTI, BEAT, FDI, which you can see. I will explain it to you while we are going it through. So the individuals who does not have the complete background also understand the complete context of what was there, what has changed, and how it will impact. So and now the OBBBA bill, which was enacted on 4th of July, has given certain exemptions plus new kind of reliefs which have been given as well in this section, and that we'll be talking about in this session. So yeah, first part for the US NRIs. So in the earlier before 2017, so I mean, just like India in the new tax regime, which we have multiple slabs, US also has a multiple slabs, 7 slab rates, which they have starting from 10% to 37%. So before 2017, it used to be 39.6, which is the highest marginal slab rate at the federal level, which was kind of reduced to 37%. However, this was the temporary, so it was going to expire post 2025, but it was in as OBBA, it was made permanent, and the highest slab, which is going to be 37%. Similarly, like India, that generally the slab rates, the tax slabs and everything kind of changes, but they have kind of made it that which in the US they call it as an inflation adjustment. So it's a every year impact which is there, and this inflation will be kind of done between the 10% to 22%. So they don't expect it to change the upper slabs, but they do expect it to change it right now for the 10 to 22% income slab. So the middle class US individuals will see deep in the tax liabilities in the coming years. So this is effective from January 1st, 2026. So wherever you are dealing with the US NRIs who are living in India, who earns the US income, and you are claiming the foreign tax credit in India, you should be looking around this, that if the liability which is going to impact them in India, if this reduction in taxes is going to happen. So this will be the important consideration for the Indian tax practitioners as well, who are claiming the foreign tax credit on the US source income. So that's on the top marginal tax rate. This is the personal exemption, especially senior citizens in the US. So we have seen many US NRIs who have earned a lot in the US, and now they are now retired, living a retired life in the India. So this kind of personal exemption will be kind of impacting them, kind of giving it as a relief, which was not there previously in the Tax Cuts and Jobs Act, which was suspended. And this exemption is kind of available as a $6,000 per individual. So if there is a husband and wife, so they in US you can file a married filing jointly return, so you can claim up to $12,000 exemptions over and above the other exemptions and the deductions which are available. So this kind of come as a small relief. This is specifically for the individuals who have the joint income of less than $150,000. So if the income is more than $150,000 in the US, this exemption will start to phase out by 6%. So this kind of relief was provided to the senior citizens who are kind of living retired life to not be impacted with the huge tax liability. So in case if you are dealing with such US NRIs living in India, this will again be one of the exemption which may have an impact on, and you will see the dip in the US tax liability of those individuals. So accordingly, you should be looking at it, but this will be applicable from 1st January 2025 till 2028. So this is the 4-year window which you should be looking at it. The next is the state and local tax deduction. So in the US, at Fed, so there's a multi jurisdiction tax. So there is a federal tax as well. There is a state income tax as well. So if the individual is living in the US in particular state, so all your income will be taxed at the federal level also and at the state level also. So there is this state income tax plus property tax, any other taxes which you might have paid, you will be able to kind of take a deduction. So this deduction was capped at $10,000 until 2025 under this new Tax Cuts and Jobs Act. However, as a good news, this has been increased to 40,000 in 2025 and 2026 to 40,400, and then it is going to be there till 2029 of what your previous year's liabilities are. However, in 2030, this is again expected to be reduced to $10,000. So irrespective of about how much state taxes you have paid at the federal level, you will be able to claim it 10,000 from 2030. Of course, there is a phase out rule for the high earning individuals. So if you are earning over $5 lakh in the US, this deduction will be reduced by 30% down the line. And this will become an effective from 1st January 2025. So this increased limit is only for next 4 to 5 years. And from 2030, we should be getting it again back to $10,000 as a capping. So wherever you have such a foreign tax credit which you might be claiming it in India, you should be looking at this deduction as well, because this will reduce the liability further for the US individuals earning below $5 lakh. Going to the next one is the US base. This has been a very interesting exemption, I would say, which is, so in India, as you know, there are many capital gain exemptions which is there under various provisions. So similarly, this is I would say, not so popular, not so unpopular as well. So some know, some doesn't know. And this is mainly for the qualified small business stock exemption. So if this was mainly introduced for the small companies, I would say, promoter driven company or startup, I would say, who issued the stocks, was holding for 5 years. When this shares were issued to them, technically the assets were less than $50 million. So any capital gain which you earn by selling off those stocks, you will up to $10 million or the 10x of the original investment. That's the exemption which you can get. So this was the original provision in the Tax Cuts and Jobs Act, which is now increased to $15 million as an exemption. Also, the issuing company's gross asset requirement has gone up. So there will be many companies which will be now covered. Having said that, this is effective from the 4th of July. So this will not be applicable to the companies who has already issued the stocks, but this will be for the going forward. So the takeaway for you will be, I would say, a couple of points. If any of your clients are planning or already a US NRI is planning to start the business in the US, they plan to acquire certain shares. So they may want to see whether they will be eligible to claim those exemptions. So from the tax planning perspective, from the US tax liability perspective, they will be able to take benefit of this exemptions up to 15 million, which is a huge amount for the many startup founders. Having said that, if the US individual is living in India, this capital gain will be taxable in India. So ultimately, we have seen many US NRIs missing out on those, and we have seen many India tax preparers as well who are missing out on this exemption. So if there is any extraordinary activity or sell-off by your clients, you should be definitely having these conversations with them that whether this exemption was claimed in the US, because the India tax law may not gives the same level of exemptions which are there in the US. So there will be definitely a liability, and we have seen many live cases wherein our clients have paid the India tax liability after 2 to 3 years with along with interest and penalties. So this will be a very key point from your compliance perspective as well as from the planning perspective also. So this is a very important your individual clients having the companies in the US or they plan to start the business in the US. Next is the reduction for qualified precedence interest deduction. So this was allowed in the TCJA also, but this was set to expire this year. However, this has been made permanent now under the OBBBA bill. And the insurance premiums, which were not deductible for the qualified residents after 2021, has also been now allows at a deduction. So this will, in case if you have a rental income or any kind of income, so which is kind of going to be taxed in India as well. So the deductibility of such insurance premium on and such interest deduction, which is allowed now in US, should also be looked at from the India tax perspective. Also, this will definitely be, I would say, very much beneficial now from the interest deduction perspective plus the insurance, because in the US the insurance premiums are very high. So it is set, it will definitely reduce the rental income to quite a certain amount, which they will be including as an income. So if you have any of your clients who owns the properties in the US earning rental income, you should have the conversation with them because this is going to be effective now from January 2026. So it may not be the immediate burning issue right now for this year, but from the planning perspective, from cash flow perspective for the US NRIs, you should be definitely having this conversation that what they plan to do with such premiums which they will be claiming and what will be the potential tax liability here in India. So that will be the important consideration which you should be having from the discussion perspective. Car loan. So as you are aware, I mean, US has been very pushing the manufacturers to produce in the US, especially automobile industry, the telephone industry and everything. So there's specific provision, especially for the car loan. So this includes any kind of car, minivan, pickup, motorcycle, anything. So this was previously which was not allowed, I would say, because there was no provision only in the initial Tax Cuts and Jobs Act. So this is kind of a new deduction which has been introduced. This is specifically, of course, for the individuals up to earning up to $2 lakh if they are filing merit filing jointly, or $1 lakh for the single filers. So this will be this is mainly to boost the US manufacturers, US purchase, which you may do for such cars, the automobile industry, because they are facing a huge issue in terms of the cost and everything. So this is benefit which they are providing. Having said that, the deduction limit has been capped at $10,000 for such interest. So maximum which you can claim is $10,000 of such deduction. Again, as I will repeat this point, that while claiming such exemptions in India will be again question mark, because India tax law might not recognize such exemptions which are available and any interest which are paid outside India. So this 4-year window from 1st Jan 2025 to December 31st, 2028, that will be the window wherein this deduction will be allowed, I would say, and you should be looking at it from the planning perspective. Such reduction will have an impact from the India tax liability or from the US tax liability. So this is a new provision which has been introduced under the OBBBA bill, which was not there previously under the Tax Cuts and Jobs Act. Yeah, so this is an, I would say, much awaited basic exclusion which has been made. So just to give you a context, so any gifts, any planning from the estate will gifts which you want to pass on to the next generation. So this was initially set at $5 million before the Tax Cuts and Jobs Act. However, this limit was doubled to $10 million indexed for inflation under Tax Cuts and Jobs Act. So technically, this 10 million kind of after the inflation was already around 14 million in 2024, 2025, which was supposed to go back to 5 million, which was post Tax Cuts and Jobs Act. So this exclusion, which is there, is very much helpful for all the US NRIs who would want to plan their trust exemptions, how to pass on to the next generations. And this now 14 million, which is approximately there now, has been made permanently to the 15 million. Of course, this will be again given an annual inflation adjustment from the next year, but 15 million will be now considered as the base year, and the inflation will be adjusted from the next year and next to next year. So this means that if your clients have assets, global assets up to $15 million, they will be able to transfer it to their next generation through any mode which they prefer it, up to $15 million without any US tax liability. So this is a very important and a welcome change which has been introduced by the President Trump, and this was very much needed, I would say, because it was already a 14 million. So making it back to 5 million would have not helped President Trump for their vote base. So that in that manner, 15 million is a welcome change, and this will kind of keep on increasing, which is there. Additionally, this 15 million is for per individual. So if you're filing a 15 million, if you're filing merit filing jointly, and if you have a joint assets, technically this limit becomes a 30 million. So this is this 30 million is a lifetime limit. So you can use it anytime in bits and pieces also. But of course, you have to keep a track and everything. So this 30 million per couple is a good amount, I would say, and it covers many US HNIs who own such assets, and they would want to pass on their assets to the next generation through gifts or wills of the estates. Moving on to the next one. So now we will be discussing the changes which will be impacting the Indian MNCs. Yeah. So bonus depreciation. So bonus depreciation. So this is a very interesting provision, which is, I would say, which was there previously also before the Tax Cuts and Jobs Act, but it was capped at 50%. So the best part about this bonus depreciation is that you can claim 100% in the first year itself. So if you have, of course, a qualified asset. So the idea is that if you are owning the assets which has a life as per US tax law of less than 15 years, you can claim the 100% bonus depreciation in the first year itself. So this provision was introduced to give the benefit, incentive, or do the US purchase. Of course, this is all this qualified property purchase has to be the US asset placed in US. It does not have to be placed outside US. So this provision, which was there in 2017 till 2022, and this 100% was supposed to reduce from 100 to 80 to 60 to 40, and then ultimately end in 2027. However, this 100% bonus depreciation has been reestimated under OBBBA in just to promote the businesses or the US purchase or the US manufacturing industry, so that the people do purchase. And we have seen many clients who are taking the benefits of this. I mean, they have purchased millions of assets and they have claimed the 100% bonus depreciation in the first year itself. So it's a huge relief if you have a good amount of business. And best part is that there is no capping as such of claiming this. So you may add 10 million, 20 million dollars of assets, and you will be able to, and you can convert it also into the net operating losses. So if you have a taxable income of 7 million, and if you added the fixed assets of 5 million which are qualified, you may be able, you may end up having the $4 million of losses, which you will be able to carry forward in the US. So this 100% bonus depreciation has worked very well for many of the asset heavy companies, I would say. And this has been a welcome change for them. This property, so this purchase for the 100% bonus depreciation, of course, has to be from now, 19 January. So if you have assets which you purchased in 2023 or 2024, the 80% or 60% limit which was there previously still applies to them. But this is now going to be with effect from the 19 January 2025. So this is not a retroactive which you can do it. So if you have any clients who are following April 24 to 25 March, there's a tax year, so they may have two types of bonus depreciation which they will be able to claim, and then down the line they will be able to claim 100% depreciation. This will also be important from the deferred tax calculation perspective, because 100% bonus depreciation will create a DTL for the books purpose. So if you have any of your clients, Indian parent, US subsidiary, where you are doing the consolidations for them, so this may become an important consideration, that because there may be a huge DTL which may rise if they are asset heavy, and accordingly the impact has to be given. So if you are dealing with such clients or such subsidiaries wherein they have it, you will see this impacting them. From the planning perspective, also you may want to have a conversation with your client in case if they intend to start the operations in the US, or if they are evaluating whether to purchase certain assets in India or US, or how it will be beneficial. This can be an important consideration. Also from the M&A deals also. So we have seen many M&A deals wherein they are purchasing the assets, or when they are doing the deals, which is kind of restructured as an asset deal. Then the assets which they are acquiring, they will be able to take, the companies who are acquiring such assets, they'll be able to take 100% bonus depreciation in the first year itself. So this become an important considerations in the M&A deals as well. So this bonus depreciation is kind of beneficial to, and at various angles, I would say. So whenever you are dealing with any clients or any taxpayers who have an asset heavy entities, this provision is something which you should be looking for. One IRC 174. So this has been a nightmare, to be honest, for the many companies, SaaS companies, technology companies, basically in the US. So just to give you a bit of a background, so R&D, which means research and development, expenses which you incur in the US until 2022, you were able to take the deduction. So when they say R&D, which includes the software development as well, so it is not clearly the R&D you will be doing it if you are doing a software development, if you are doing a software improvement in the US or in outside the US. And we have seen n number of companies who have the offices in the US but the back office in India, who are doing this. So until 2021, the companies were able to take the deduction of such R&D expenses, software development expenses until 2021. However, in 2022, this under the Tax Cuts and Jobs Act, this was supposed to be capitalized and amortized over a period of 5 years for the domestic expenses and 15 years for the foreign expenses. So I mean, you can imagine that you are including the income 100% in the year, but the expenses which you are incurring for such, I mean, earning the revenue, you'll be able to take the deduction over a period of 5 years or 15 years, depending on where you are kind of incurring those expenses. So it was everyone was expecting that this will come as an extension, but it didn't come in 2022. This was there are many companies who were affected by this. There are many present representations also which were made to the government previously and to the President Trump to how whether this foreign research should not be I mean treated in the same manner, because we are including the 100% income. But under the OBBA, I would say a slight relief which was provided. So the domestic R&D, they agreed that as long as you are doing in R&D, and as you know, the President Trump has been pushing extremely to all the companies to produce and to provide services to generate employment, to do the business, everything in US. So to give the benefit and to push that agenda, the domestic R&D expenses became fully deductible starting from January 1st, 2025. However, foreign R&D is still a challenge, and it will be amortized over a period of 15 years. So if you are dealing with the companies wherein you see the model which I mentioned, and they are outsourcing or have the offshore units outside the US for their mainly the businesses, this software, the software development or for the R&D work for any other, this section is something which you should be definitely looking at it, because it will have a huge US tax liability for them. And this is going to be impacted from 1st January 2025. Having said that, the small companies, when I say small companies, means the average gross receipt of 31 million in last 3 years. So if you have such companies, then the domestic amount which were already capitalized in the previous year in 2022 or 2023, you will be able to deduct the unamortized amount directly in full. So this is more to give the relief to the such domestic US taxpayers, and or alternatively you can amortize it over a period of 2 years starting from January 1st, 2025. So it's a choice which has been given from the tax planning perspective for how you want to do it. But this foreign R&D, to be honest, is a nightmare for the many companies who are offshoring that, and this provision will definitely impact that. So if you are having such clients, the technology companies especially, who are majorly impacted by this, having the US parent or the US subsidiary from that perspective doing the business here, so you should be having these conversations with them that what you are doing it. If you're signing off on the financial or signing off on the audits, this should be one of the agenda, or I would say that what you are doing it for this section which has been come unto now, and how do you intend to take care of it. So from you as an auditor, you as a tax preparer, you should be looking at this section very carefully, because the companies are still figuring out, to be honest, after 3 years. So this is a very important section to deal with. Yes. So the next one is the limitation on the business interest. In the Tax Cuts and Jobs Act, initially in 2017, there was a capping which was provided that if you have a positive EBITDA, then ultimately you will be able to deduct up to 30% of such EBITDA, and under the Tax Cuts and Jobs Act. However, that was changed to EBIT a couple of years back. So kind of depreciation, which you can see, so you can relate it to the bonus depreciation point, which we discussed previously and now. So now if you have for the 30% limit, if the depreciation has been removed, so the limit will kind of significantly reduce it there for the interest expense. Whereas if you are kind of considered as an EBITDA, your limit will be significantly higher for the expense, interest expenses which you are claiming in the US. So and the Tax Cuts and Jobs Act in last couple of years, the depreciation was removed, and the limit which was there was EBIT, business interest income plus 30% of EBIT plus the floor plan financing interest. So floor plans financing interest is mainly for the automobile industry, mainly majorly being triggered by that. But now under the OBBBA, this has been reinstated, I would say, and the depreciation has been given, and this will be the major relief for such companies dealing with the heavy depreciation and the heavy interest, who has the high, more borrowings on that perspective. Having said that, when there is an exemption also which is available currently, in previously also and currently also, that if your business is having a gross receipt of less than $31 million in last 3 years, then this section is not all applicable altogether to you. So if you have such clients or such business who fall under this might not be impacting you directly. But whenever this threshold is crossed, you will be seeing major benefit because of this EBITDA, which has been restored under the OBBBA. Additionally, it will, if it's an India-owned US subsidiary, you will see on the deferred tax part as well if there is a disallowances. So whenever you are considering it, whenever you are reviewing the financials of the US entity where you may be signing off, this may be the important considerations if the US entity is paying the interest from that perspective, and accordingly you can suggest or advise some of your clients to take a loan in the US if it making sense from the tax planning perspective, or how the math is working out for them. So this is an important consideration for the Indian tax preparers who are signing off on the audits, who are signing off on the tax returns, wherein the US incomes are included in India. This is kind of effective from 1st January 2025, and for all the companies. So previously for until 2024, it will still be EBIT, but for 2025 it will become an EBITDA. Yes, so GILTI. So another very important for the US parented group, I would say. So just before we kind of jump into the changes, I'll just give you the context about what the GILTI is. So before the Tax Cuts and Jobs Act, the US parented companies having the subsidiaries across the globe, they were not subject to the income in the US until it was repatriated. So this GILTI was introduced in Tax Cuts and Jobs Act 2017, stating that all the incomes now from year on year, all the US parented group will have to include all the incomes of their subsidiary in the US. So this became a huge change for many of the US parented company, because there were many of our clients as well who were US parented company, because they wanted to raise money in the US. They opened subsidiary across the globe, and because of the transfer pricing regime, they were following cost plus markup. So they were kind of worried about that the subsidiaries are in profits, but US is in losses. So how we will be working out? So in 2017, it was quite, I would say, an effort which everyone put in to see what the impact is, but it has kind of settled down. and the changes which were brought in were under the OBBBA for the 3 parts only. So what does this mean? Guilty is that net CFC. CFC means controlled foreign corporation, which is if the US shareholders are owning more than 50% in the foreign company, which in our case, if it's a US parented subsidiary, it will be technically 100% subsidiary. Net CFC tested income, which is the taxable income, I would say, of that subsidiary minus the 10% of the QBI. So QBI is for your qualified assets investments. So those in those subsidiaries, you might have certain assets which you tangible assets which you might have purchased, and minus the interest expense. So this was there previously under the guilty. So net CFC tested income minus 10% of those qualified assets minus the interest expense. So this whatever the tested income which you arrive to, you were getting it 50% reduction as well of the guilty, and technically your effective tax rate becomes the 10.5% before any foreign tax credit. So in US, the tax rate is 21% at the federal level. So 50% becomes your 10.5%. So any income which you might have assumed you don't have foreign tax credit, you are including effectively 10.5% of such a foreign source income or the foreign tested income into the US. Now coming to the OBBBA, how it has changed. So this 10% of QBI, which was there, that has been completely eliminated, which means that the pure income which is there of the net CFC tested income now will become completely taxable to the US taxpayers. So this US tax, so again, this guilty is not specifically for the US corporate. So if your individual clients are owning it's a US citizen owning the companies in India, it is applicable to them as well. So it's a US shareholder and not the US corporate. So whenever you are dealing with such clients, wherein either US individual directly, indirectly owning foreign corporations, or the US companies owning directly or indirectly the foreign companies, this guilty will be applicable to them. So until 2025, the Tax Cuts and Jobs Act deductions prevail. This 50% reduction under the Tax Cuts and Jobs Act was supposed to be reduced to 37.5%. However, this 37.5% reduction has been kind of settled and permanently reduced to 40% now. So the effective tax rate now will become the 12.6%, I would say, which will, so if you include any subsidiary income in the US of foreign subsidiary income in the US, ultimately that income will be taxed at 12.6% post the guilty deduction. So this is something which is changes many, I would say, maths around about how the transfer pricing regime will also work, because while you may be dealing with the transfer pricing of the subsidiaries wherein they have a US parent, this has to be looked at holistically. It does not have to be looked at from the India perspective only or from the US perspective only. So the tax preparers who are dealing in transfer pricing, who are advising on transfer pricing as well, this factors has to be looked at, and accordingly the advice has to be given so that the minimal overall group liability is evaluated. Accordingly, this will become an effective from January 1st, 2026. So for 2025, it is still 50% of the guilty deduction, and still you will be able to get the QBI deduction, but this will not be available from 2026, and the guilty deduction has become permanently to 40%, making it the effective tax rate to 12.6%. So this with this many guilty provisions which you might see in your clients, wherein you might be your clients may be owning directly, indirectly. Please have these conversations with them, understand what tax implications which this might create for them, and accordingly they will have to see how tax planning further tax planning has to be done. Uh, Moving on, this is again to the respect to the guilty what we discussed. So the in the guilty part, whatever the income, the 10% or 10.5%, ultimately the effective tax rate which we discussed here. If in India, say for example, those foreign subsidiary might be paying it as an income tax in India as well. So that was available after the haircut of 20%. So ultimately, whatever the taxes has been paid by such foreign subsidiary in the local jurisdiction, 80% of that was available. Which has now been increased to 90%. So this is a welcome change, wherein on one side the guilty deduction has been reduced by 10%, but the foreign tax credit has been increased to 90%. So what it means is that if the foreign subsidiaries have paid the sufficient tax, I would say there will be no problem. So approximately if more than 13.125 effective tax rate, if it was paid under Tax Cuts and Jobs Act, there would not be potentially any federal tax cash outflow because there will be a foreign tax credit. How did I arrive to 13.125, which is 10.5 divided by 80%? Whereas now under the OBBBA, this 13.1 will be over and above slightly to 14%. So 12.6 divided by 90, so approximately 14%. So if the foreign subsidiaries have paid the enough taxes in the foreign jurisdiction, they are still covered, and accordingly they will be able to take the credit in their US tax return. So wherever there are considerations for the foreign tax credit, if them in India, you might be claiming it the SEZ benefit, or you might be claiming it the losses or anything in the India. So this will have an impact, ultimate impact, while providing or while claiming such credit in the US. So what it means is that while it may, or while you may plan something for US parented India subsidiary to claim the benefits in the India, but it might have an adverse impact in the US. So while providing such advisories or everything, it has to be looked holistically, that if how this income of this India subsidiary will be taxed in the US, because it might give a benefit at India level, but it might not be beneficial at the US level. So the holistic analysis, the holistic picture has to be looked at from the tax planning perspective, especially from when I mentioned about the US parented companies, directly or indirectly, if your clients is being owned. So wherever such clients are there, please have such discussions with them. And these changes will take effect from next year for the 90%. Yes. Beat. So base erosion minimum tax amount, this was again very important provision. This is for the large company mainly, I would say. So large company, when I say if your clients have presence in the US with the multiple entities or a single entities with average gross receipts of more than $500 million. So in the US, not the global ones. In the US, if you have more than $500, then technically this beat will be applicable. So there were this beat is more of an tax which is over and above your income tax which you are supposed to pay. So ultimately, this is an over and above your normal income taxes. There were certain add backs which you are supposed to do it, which you have paid to the foreign affiliate. So what it means is that if you if there is a heavy payment, or you are not keeping the sufficient profits in the US, or if you are using the multiple tax tax avenues, which is kind of decreasing the US tax liability significantly, which is less than the BEAT liability which you are calculating. So your regular tax liability should be or equal to minimum of BEAT tax. So this 10% was supposed to increase it in 12.5%. However, under the OBBBA, after the heavy negotiation, this was reduced and made permanent to the 10.5%. So this will be effective from 1st January 2026. There was an interesting discussion around the Senate Finance Committee as well, wherein they in that version of the bill, it was introduced that if the company has paid a high sufficient tax, sufficient, there was no definition which was given in that bill, but if it has paid a sufficient tax in the foreign jurisdiction, then the BEAT will not be completely applicable to them. So this technically did not make it way through the final bill, but that was an interesting provision, and this BEAT is kind of impacting many Indian MNCs as well, many listed companies as well, who are having the customers base in the US, providing services from India, having the offshore units here in India, and they are being beaten by this BEAT. And they are paying the liabilities under this route. So this is, I would say, from what they were expecting from 12.5 to now settling it permanently at 10.5. I would say it is a welcome change for them. And there are certain exclusions as well, which were initially there. Accordingly were now removed under the OBBBA. So that's a more of a negative part. So certain payments which you're making it to the India subsidiary or India or any other foreign subsidiaries that they were not considered under this BEAT. So any payment from the US to a foreign jurisdiction is kind of covered, but there were certain exemption which has been removed. So how this is important, how this is relevant for you, of course, from the audit perspective. So when you are doing or when you are conducting the audit of such US parent company or the India parent company having the project. So this is not only applicable if it's an India parent, it is applicable irrespective of anything. So if the US is making the payment to any foreign affiliate, ultimately this will become a very much relevant for them. So if you are signing off on the financials, ideally you should be asking it if they are crossing, of course, the threshold, that with how the US company is mitigating this liability and how it has been taken care of. Additionally, this may create again from the transfer pricing perspective that how much payments, how much profits are being retained in the US and how much margins are being kept in India versus that. So the transfer pricing planning now may be required or revisited for the benchmarking which you might have done for your clients, which are being impacted by the BEAT provisions. So I would suggest that we still have 4-5 months to plan it now. And if it has not been already been done, or if your clients are expecting to cross this threshold in next 1 to 2 years, please have this conversation now itself in order to plan it better, your global tax liabilities. Having said that, the BEAT was introduced under Tax Cuts and Jobs Act, and it is going to be there at now at 10.5, but sorry, at 10% until 2024. But now it will be permanently at 20.5 from the 1st January 2026. So please have a conversations and plan your taxes accordingly. Moving on. FDI. So this is a very interesting exemption which was given, and I have seen personally many clients who have taken this benefit. So this was introduced under the Tax Cuts and Jobs Act, wherein if you have provided or if you have given the foreign export service or if you have done a foreign export products from the US. So, I mean, we have had one model wherein they were importing from somewhere in the US and then they were exporting to the other countries. So that was I mean, we have seen seen from the services also that they were providing services from the US. So this section was technically introduced to promote the export of from the US economy or by the US taxpayers, and for the US eligible profits for such foreign income, you will be able to take the deduction of 37.5%. So assume that, I mean, if you are doing it 100% of this, you will be able to, I mean, your claim the reduction of 37.5%, and your effective tax liability will now become at 13.125. So that's a huge relief, I would say. If and from the planning perspective also, when you are while you may be advising your clients on how to take the benefits of various jurisdiction, and if they are planning to do the export of this business, this can be one of the very much beneficial position which has been taken by many taxpayers, and it has been there. So now only the change in the OBBA has been that this 37.5% has now reduced to 33.34%. So which is still, I would say, beneficial, because the your effective tax rate will now to be in 14%. So wherever I mean, if it's a the India parent and the US branch or kind of a something, you may plan it around that. Plus, from the foreign tax credit perspective, also there may be an impact at the India level, considering that if you are claiming a foreign tax credit for such branch taxes which has been paid by in the US, and if you are including it in India, then this might become a cash outflow at the India level. So whatever, I mean, the clients you are dealing with, and if this is beneficial for them, or if this is impacting them, you should be having such conversations with them, that how they will be able to take the benefit from the tax planning perspective also, and from their India tax liability perspective also, if they are supposed to include the income in India. Having said that, the effective date has not been explicitly mentioned in the act. We do expect a notification or something from the IRS on this perspective, but this is likely to be from the next year, considering all the other corporate changes are from the next year. So we still await the effective tax rate, but as I mentioned, it has not reduced drastically. So the effective tax rate will become 13.125 to 14%. And this deduction is only available to the foreign source, or kind of, so only those kind of export services or the profits, export profits, which is, if you have an export plus domestic, then you will have to bifurcate it and claim it accordingly in the US for such taking the benefit. Yeah, moving on to the last part, I think I'll just cover the two important aspect. So there is an excise tax, which has been very much making a buzz, I would say, around when it was in news also, that now, I mean, every US individual who are remitting the money, or whoever is kind of making the payment now from US, is supposed to pay this 5%. So everyone was worried that I mean, it's a 5% extra cost, whether I'll be able to take the credit or not. I mean, so there were many versions of it. So this was initially a 5% in the House bill, which was later reduced to 3%, and ultimately it was, after heavy negotiation, it was reduced to 1% with the major exemptions. So ultimately, so the idea behind introducing this exemption was that there are many, you must have seen that there are many undocumented migrants who have stayed in the US, never came back. So they did not have officially any social security number. They were earning in cash. They were repatriating the money from the US to their local, wherever they were belonging from. So there were heavy cash outflow, which was kind of happening in. So this exemption which was provided, it's that if the transfer was made through a US regulated for financial institution, bank, credit union, etc., you are doing it from a bank account. So, I mean, you in US, you'll not be able to open the bank account with a social security number. So if you have a social security number, you are not undocumented. So if you are having a debit card or a credit card, which means you are documented immigrant earning legitimately in the US. So this exemption came as a major relief, I would say, and 98 to 99% the people who are emitting kind of were removed from this. So this kind of ended up being for only for the individuals who are kind of undocumented in the US, remitting it from the US to the local jurisdiction, and the 1% will be there. So this was kind of given major exemption, and that become a huge relief, especially for the Indian individuals who are residing in the US, which they tend to remit a huge amount to the India from time to time. So this became a welcome change, I would say. And initially also there was a discussion that this 5%, 3% may be available as a credit while filing the tax return or so. But ultimately it was ended up at 1%, and that became a good relief, I would say, to the documented immigrants or the documented green card holders or the citizens. So this was mainly to prevent through the hawala or through undocumented or unauthorized money transfers which are there in the US or in any other parts of the world. So this is mainly to cover them. Moving on, so this revenge tax, this ultimately revenge tax did not make it way to the final bill. I would say it was so there was a huge pressure from the G7 nation, and if you recollect, this G7 meeting also happened somewhere in June or so. So there were a huge backlash from those G7 nations. So wherever there is a favorable tax benefits and everything, wherein the foreign taxes are below the threshold, they would want to increase it from step by step until it reaches the above statutory rate. So it was, I mean, the unfair taxes were supposed to reach at approximately 30-40% technically, but it kind of didn't went through. However, I would suggest that the multinational businesses and the taxpayers should monitor this future development in case it comes in. However, for now, this has not been part of the bill, so there is nothing to, I would say, worry about as of now for this act, and accordingly, you will be not seeing it, at least for update on this OBBBA from the IRS side. Having said that, you should be keeping eye on this revenge tax in case if it comes in the future. So with this, I will just end my presentation here, and I'll be happy to take any questions the audience may have. Yeah, I think Tushar has a question. Tushar can someone please unmute Tushar?
There seems no question as of now.
Yeah, I think Tushar has a question related to BFIC. So
One speaker. Yeah.
I think meanwhile I'll just take Anish Javeri's question. So 1%. So his question is 1% excise tax is applicable on all items or only on outward remittances. So
Right.
this is specifically for the outward remittances. So earlier it was kind of introduced that all the outward remittances from the outside US was supposed to be at 5%, which was proposed in the House bill, but this was ultimately reduced to 1%. So again, this excise tax is only now applicable for the remittance which are through the cash or through undocumented immigrants who are doing it who does not have a valid SSN. So it will not be levied on the remittance which are through the banks or through the verified sources or through debit card, credit cards, kind of that source. So I would say 98, 99% individuals in the US who are documented will not be covered under that. I hope
Okay.
I've answered your question.
Thank you, sir. I think Tushar, you can type the question so that we can take it to the faculty. So one question from my side.
Sure.
What immediate challenges will Indian subsidiaries of US MNCs face under this bill?
I'm sorry, come again.
So what, according to you, would be the immediate challenges that Indian subsidiaries would face because of this bill?
Sure. So I would say one, not one, two, I would say. So 174, what we discussed for R&D specific. So if you are a company dealing or having the SaaS business or the technology business in the US, and if your clients are from US, you are doing it, outsourcing work, developments, everything which is happening from India. Technically, it will be disallowance of the expenses which you might be claiming it because of the transfer pricing in the US. So that will be amortized over a period of 15 years. So that becomes a huge setback, I would say. Having said that, domestic is still allowed if you're doing it R&D activity or software development activity in the US, then you are still good to go because they have allowed the deduction for the domestic R&D work, but the foreign R&D will be something which will become an issue for you. The second challenge which I see immediately is that if you are a large entity having the presence in the US, I would say when I say large, 500 million or above a gross receipt in the US, then accordingly you will have to see from the BEAT perspective also. So there are, as I mentioned, that there are many US companies. I mean, this kind of large entities will also have the back offices in India. So there are many Indian listed technology companies who have this model, earning millions in the US, having revenues there, but back offices here. So this BEAT will be something that's 0.5% will directly hit their P&L because this is not available as a credit. So if they are taking the huge benefit, if they're taking the huge reduction in the US under their transfer pricing, and we have seen many clients in our circle also who are kind of already now revisiting their transfer pricing policies on how much profits to retain in order to keep the regular tax above the BEAT liability in order to prevent this BEAT taxes. So these are the two immediate challenges which I would see that you should be having a conversations with your client.
Thank you, sir. Thank you so much. Any of the panelists would like to add something or any questions? Okay, there is a question from Tushar. My client is a person of Indian origin and she holds mutual funds in India. She is worried about PFIC. We have finalized working by M2M method, but she is keen to check how vigilantly this provision is followed by Indian persons working in USA. And I think almost everyone should be having MFS in India.
Sure. Tushar, I would say you are not the only one who kind of face these questions. So many of our clients who are kind of, and I would say PFIC is kind of becoming more of a popular now. It was not there back then, 10 years, when 10, 12 years when I started my career. But yeah, I mean, so PFIC, I would say it's IRS is now looking at it. I would, because now IRS has been very aggressive in terms of looking at the international reportings. So we have seen many of our clients who have disposed of the mutual funds as well because they did not wanted to go with this PFIC. So they are going through the AIF route, or they are holding the stocks directly, or they will be investing into the US mutual funds or more of that further. So, but I mean, I'll not be able to say how closely they are monitoring it, but in case of IRS audit, definitely they do look at it. And this PFIC has been very notorious provision, which is there in the US. And we have seen our clients paying the taxes on the unrealized profits because they will say like, I don't even have the cash in my hand and I'm paying tax on it, and which I don't know if I'll be able to get that money or I'll be able to earn that profit in the future or not. So I feel you from the tax preparer perspective, but it has been there, and I mean it will be definitely be monitored by the IRS in case of IRS audit.
Correct. Correct. Second question in this context, if she follows this provision, then whether she will need to pay the dues for the prior years? If yes, then whether she needs to pay the heavy penalties or if there are any waivers to such penalties? What happens if she does not comply with it?
So in the US has one interesting procedure, the streamlined procedure, which they call it. So what it means is that if the US taxpayer has failed to comply on their international reporting obligations, more of that, so they will be able to file the tax returns under the streamlined procedures for last 3 years, plus 6 years F bars. So they will be able to claim the penalty relief, I would say, under this streamlined procedure. And from there on, they will be able to report it every year. So if you are coming forward and filing under this streamlined procedure, you are good to go. Having said that, streamlined procedure is not as easy as it sounds. So we will have to, I mean, you should be looking at it, the complete facts, after consulting the attorneys and everyone on whether you will be eligible under the streamlined procedure or not. And if you are eligible, then you will be able to definitely get out of this mess. So we have helped many of our clients through this procedure, and we were successfully able to do it.
Thank you, sir. Any other questions, or can you quickly go through the GIITI provisions? GITI
Sure.
provisions, yeah.
Yeah, so guilty provisions are mainly, as I was mentioning, is for the US parented companies. So guilty global intangible low taxed income, which in short form is called as guilty. So if their India parent 100% foreign subsidiary is there, so the provision is that CFC means controlled foreign corporation. So what it means is that if a US parented company having interest in the foreign corporation for more than 50%, or the US NRI directly or indirectly owning more than 50%, collectively, I mean, it may not be only by one person. It is if there are five individual, 10% owning it, then also it's a CFC. So if that is such case, then ultimately you will be required to include the income of such foreign subsidiary in your either individual tax return or the US company's tax return, whatever may be the case. So accordingly, you will have to include the income, whereas you will be able to take until this year, I would say you will be able to take the deduction of the qualified assets, which is being owned by the foreign subsidiary. So 10% of such qualified assets, and minus the interest expense. So if you have the foreign subsidiary is paying the interest expense as well, then you will be able to take the deduction of such interest expense as well. So this is the guilty. Now the changes which is being now done under this is that the 10% deduction, which is there for the qualified assets, has now been removed completely. So that will become, so ultimately you were able to, if you have a $1 million assets in India, technically you will be able to take $100,000 deduction against your guilty income. So that was a huge relief, especially wherein there are many startups we have seen who kind of have the US parented company because they want to raise the funds, and they've opened the subsidiary in the US and offices they have across the globe. So those heavy US parented companies, we have seen that this will be impacted to them. This guilty, of course, is again 50% deducted before including it income. So if you have $100 net inclusion, 50% you get a deduction, and you include $50 in the US tax return. This 50% has now been reduced to 40%. So now you will have to include $60 instead of 50 in the US tax return.
Okay. Thank you, sir. So previously unamortized R&D expenses can be deducted or they can be carried forward.
So for the small taxpayers, ideally there has been relief which has been given. So relief, when I say small taxpayers, means 31. If you have an average gross receipt of less than $31 million, so if you will be able to elect it, and whatever last 2 to 3 years, so this provision kind of became effective from 1st January 2025. So for whatever capitalization you might have already done in last 2 to 3 years, you may take, you may do the retroactive election and take the 100% deduction of such unamortized amount, or you will be, you can claim the now amortization in the next 2 years itself. So you divide the amortization for 2 years and claim it off. And but of course, for this is for the domestic only. Foreign, as I mentioned, is still to be amortized over a period of 15 years, and this is not available for the foreign R&D expenses.
Correct. Thank you so much, sir.
Sure. Tushar, so I think for what would you advise? So I mean, this is on a case-to-case basis, and I'll not be able to comment on this webinar during the webinar. So we can connect one-to-one. You can ping me on LinkedIn, and I'll be happy to chat with you.
Should we move towards the end of this program?
Yeah, I think we are good.
Yes, Shrenik bhai, thank you so much for your valuable times. I think very, very interesting topic, and it will be very useful for all the members. Thank you to Hina madam also for sparing your valuable time.
Thank you, sir.
Thank you so much, sir, for
Thank you.
providing this opportunity. Thank you, Jinal ma'am. Thank you, Ketan sir, all the dignitaries. It was a privilege to be part of and to share my knowledge, and I look forward to providing more such sessions for the WRICS and when such opportunity is presented. So thank you so much again.
Thank you.
Thank you,
and
everyone.
Thank you, Shrenik,
thank you all for
for
joining.
your valuable insights. Thank you, Chairman sir. Thank you,
Thank you.
Hina, for
Thank you.
coordinating today's session.
I would like to extend a formal vote of thanks, and I would first sincerely thank our chairman, sir, for giving this opportunity, and to our distinguished faculty, Shrenik, sir, for your insightful session today. Thank you, Jinal Savla, ma'am, for smoothly anchoring today's program, and also my co-coordinator, Akansha, for introducing the faculty. Finally, a heartfelt thanks to all the members and participants for joining us this evening and making this session a meaningful one. Thank you, everyone. We formally conclude this session.
Thank you. Thank you, everyone.
Thank you, sir.
Thank you.
Thank you, everyone.
Thank you.